Hi, everybody, and welcome back to Fang Friday. This is Ross Healy, the chairman of Strategic Analysis Corporation and a senior portfolio manager at McNichol & Associates Asset Management. I'm guessing that nearly everyone in our Fang Friday viewing audience would like to see what happened to Netflix yesterday from an SVA perspective, given our sell rating on the stock, and what it may now mean going forward from here. So that's where I'll start today when I review the FANGs plus Tesla. But I would like to start with a summary overview of the NASDAQ 100 before I do. What I found could be very instructive, particularly for two of the FANGs. Well, one of the FANGs plus Tesla. When I scroll through the NASDAQ 100 to see what has taken place since that index first reached its high bubble one price, its HB1 price at 10 times book last October, what stands out stunningly is that the stocks which have been hurt the most are those with very poor or no fair market value support. That's the dotted line on our SVA charts. In other words, when markets turn weak and we get a peak valuation signal from the market itself, that is the NASDAQ, which first occurred last October, it is the stocks with the poorest fundamental support that tend to get crushed the most and the earliest. This being Fang Friday, of course, I do not talk about the rest of the NASDAQ, but the nearly 50 NASDAQ stocks, or just about half of the NASDAQ 100, which have been really hurt this far, and by the way, could still be hurt going forward from here, share a common thread: poor fair market value support. Knowing this about your own stock holdings might still save you a lot of money going forward from here. Things are not over yet, and I fear that the weight disadvantaged lady has not even begun to warm up her throat. If you have recently found yourself feeling the anxiety of a market that keeps slipping, sort of dip after dip, and want to have somebody in your corner, now is an excellent time to sign up for our service so that you do not go through this alone. Send us an email at info@strategicanalysis.ca. I'll tell you more at the end of the video. Anyway, before we take a close look at the FANGs, as always, I do like to say thanks to everyone who likes this video and all our subscribers. Well, I promised that we would start off with Netflix, and here it is. Now, unfortunately, I have to show you a very, very long picture of the stock because almost in the past 8 of the past 10 years, the stock has never been below its HB2 price, and of course, that is exactly what happened. The stock was sort of coming down to the HB2, and then it just plunged through there on those weak results. So, are we just about finished the downside of this stock? Well, let me go back again to the longer picture. We see that it is approaching its HB1 price, but I have to tell you that that is not a particularly strong mathematical support level from an SVA point of view. Where we have real strength and powerful mathematics to back it up is at the bubble price, which is 7.4 times book. There's no guarantee that the stock is going to get there, of course, and maybe it will simply bounce at the HB1. But what I am saying is that the NASDAQ I do not think, has finished its downward trend. I would wait before I did anything about Netflix at this juncture. Microsoft is, of course, sliding. Maybe it's sliding into first base. I don't know, but it's kind of sliding into its HB2 price at $290. That's 12 times book value. It's going to be interesting to see if the stock can hold. Of course, we haven't seen their quarterly earnings as of yet, and maybe like Netflix, we'll be glad that we didn't do anything about Microsoft too early. NVIDIA, which gave us a beautiful sell signal 2 weeks ago, that is, it broke support and then rallied to it, and now is in a very powerful downtrend. May stop at the HB4. It did back here in October of 2021. Maybe it'll do it again. But, if I look at the fair market value potential of this company, okay, it's minus 66%. Doesn't exactly, given what's gone on with the rest of the NASDAQ stocks, does not necessarily give me a great deal of comfort about the stock being able to stop here after just a one breakpoint decline. Alphabet, well, I really kind of secretly like Alphabet a lot. However, it very much looked to me as if we were going to get a setback in the stock. I put the stock on our sell list, and it's slipping down towards support. Of all the stocks, with the exception of all the FANGs, that is to say, except for Meta, Alphabet actually has the least downside risk. It's only minus 24.6% as of today. So maybe it will hold very nicely at its mid-super growth price. That's 4.5 times book value. I'm kind of thinking it's got such a distance to fall that it probably will. Meta, same story. If I look at the fair market value potential, only minus 21%. Okay, and the stock actually has not been behaving too badly in this market, and has just been drifting kind of slowly down to its own MSG price. That's 5.5 times its book value. The only thing about Facebook that would be of concern to me is the fact that when I look at the fair market value, I can see that it is in a bit of a downtrend here, so that perhaps portends some underlying weakness in the stock beyond the MSG price. Apple. Whoa, what are we going to say about Apple here? It very much appears as if, regardless of my expectation for a change in the trend of these structural prices because of share buybacks, it very much appears as if the market has said, look at Ross, forget anticipating where that's going to be. In point of fact, the market is not going to go above its HB6, and for the last number of months it has not done that, and has now actually slid towards its HB5. So the break here at the HB5 may be more significant than I suspect. We're going to know soon enough when Apple reports and we get a new balance sheet, but nonetheless, this does concern me quite a bit. Now, turning to one of two stocks in the FANGs plus Tesla that do concern me, and do concern me a lot. The first one is Amazon. And Amazon has broken its HB2 price, and that is a 10-year valuation low. I suspect that this is a serious breach, and frankly, I would sell the stock right now. I do not wish to find out what might happen. And when I look at its fair market value potential, which is minus 68.86% below the current price, this stock gives me no comfort whatsoever, having broken strong support. Lastly is Tesla. And to give Tesla its due, it has been struggling at its own HB6 price. That's 33 times book value. Well, is it going to hold? Who knows? When I look at its fair market value, it's actually accelerated a little bit, which may account for it being so strong. However, when I look at its fair market value potential, I see that it's minus 84.65%. Well, I've seen in the NASDAQ 100 a bunch of other companies that had that kind of downside, and boy, have they ever fallen. So Tesla gives me no comfort whatsoever, particularly in a bearish market. In summary, as I reiterated in the past 2 weeks after my overview of the FANGs, my reaction was definitely to be on the cautious side of these stocks, and indeed the overall NASDAQ 100 as well. As of last week, there were only 3 of the 7 FANG stocks plus Tesla in what I call my Phantom FANG portfolio: Amazon, Apple, and Tesla. NVIDIA having failed to hold its HB5 value at 26 times book and gave us a confirmed sell signal. As of this week, 1 of those stocks has given us a solid sell signal, and the other 2 look kind of ready to throw in the towel as well. In regards to my survey of the NASDAQ 100, which I mentioned earlier, looking at Amazon and Tesla, what really stands out is that their fair market value measure is between 70 and 84% down from current prices, with NVIDIA not far behind. Amazon worries me the most, as its fair market value is now tilting lower, not higher. Given that the shares have now broken below their 10-year valuation low. If there is any disappointment in their current results, which are expected out shortly, this stock may now be signaling that it could get mauled. I would not now remain invested in this stock under current circumstances, and I suspect that in a day or two, the same thing may well go for Tesla and Apple. Looking at Google, NVIDIA, Microsoft, and Meta, all 4 are in clear downtrends that will either take a lot of strong upside market action to reverse, or will permit them to fall to levels which may offer strong support and therefore good trading opportunities. My best advice here is to wait for it. I hope that if you've learned anything from SVA in the past 2.5 years, is that patience is often rewarded, but you need to be ready to take advantage of opportunities when they occur, as they tend not to last for very long. When the NASDAQ 100 reaches its own intermediate downside target, its bubble price, we may well have a solid buying opportunity in the FANGs, those FANGs which reach support at the same time, as usually has happened in the past. As a reminder of what I've stated before, I do hate to see Amazon break support because of the potential implications for the NASDAQ stocks in general. It was sort of my personal canary in the coal mine. As I was careful to point out this week in my review of the stocks themselves, the intrinsic value of the FANGs and Tesla are typically well below their current prices. I watched the same story unfold in the 2000 to 2002 period, and it was not pretty. Although there were lots of great trading opportunities on the way down to their final lows. I started with Netflix, and I'll end with it. The logical question that you may have is, so what should I do about the stock now? After all, we have avoided more than a 40% plunge since December. To start with, the nearest breakpoint, the HB1, is not a particularly strong support level. It may turn out to offer good support this time around, but the NASDAQ itself has not reached support as of yet, and I personally would not be in a rush to try to catch a falling knife. To my way of analysis, the bubble price would offer both technically and mathematically very strong support. I think that I would gamble a little and wait right now. As a final thought, now that you have seen how poorly stocks can perform in weak markets when they have no decent earnings and fair market value support, if you'd like to see where your own stocks are sitting in order to assess the riskiness of your portfolio, email us at info@strategicanalysis.ca, and let's see if SVA can keep you out of trouble and make you money as well. For now, this has been Ross Healy, the chairman of Strategic Analysis Corporation and a senior portfolio manager at McNichol and Associates Asset Management, reminding you that nothing, including investing, is difficult if you have the right tools. I'll see you all next week.